Welcome to the deep dive. We are jumping straight into Meta's Q3 2025 numbers and what they're telling us about the future. Our mission today, get past the headlines, figure out that huge tax thing, and see where Meta's really putting its money.
Yeah, it was definitely an earnings report where you had to read the fine print because, the top line looked fantastic, but the bottom line looked like a disaster. We kind of need to bridge that gap.
Okay, let's start with the good news then. The operations. I mean, really strong, right? Total revenue, $51.24 billion. That's up 26% year over year, even 25% without currency effect.
Impressive growth, yeah. Costs were up too, though, 32%, hitting $30.71 billion.
True, but operating income still climbed 18% to $20.535 billion. That just screams core health, doesn't it?
Operationally, yes, absolutely. But then you get the number that, well, it shocked the market. Stock dropped over 7% after hours. The GAAP diluted earnings per share, just $1.05.
$1.05. That's an 83% drop year over year in net income. For a company growing revenue like that, I mean, it doesn't make sense on the surface. What happened? Where did that $1.05 come from?
It's pretty much all down to one single huge accounting item, a massive non-cash income tax charge. $15.93 billion. Just added to the tax provision, it basically wiped out almost all the profit for the quarter.
$15.9 billion. Okay, hang on. For those of us not deep in accounting, what's this One Big Beautiful Bill Act and this valuation allowance? Can you break that down?
Sure. So fundamentally, U.S. tax laws changed. You've got this OBBA, the One Big Beautiful Bill Act, and also how the corporate alternative minimum tax is being enforced. When rules like this change, companies have to look at their books, specifically their deferred tax assets.
And what did Meta find when they looked?
Well, they decided they needed this valuation allowance. Think of deferred tax assets like IOUs from the government for future tax breaks, maybe from past losses or investments. But these new tax laws, especially the minimum tax part, make it less certain Meta can actually use all those future breaks. So taking this $15.93 billion allowance is Meta saying, look, because of these new rules, we're less sure we'll get the full value of these future deductions.
Yeah.
It's an accounting adjustment, not cash going out the door, not bad sales right now.
Okay, that context changes everything. So if we mentally pull out that one-time tax hit, what's the real operational story? What are the adjusted numbers?
Right, and that's where you see the underlying strength. If you ignore that non-cash charge, the adjusted net income, $18.64 billion, and the adjusted diluted EPS, which is what analysts really focus on for, core performance, $7.25.
$7.25 versus the reported $1.05. So a $6.20 difference per share just from that tax adjustment. So the headline number was an accounting necessity, but the actual business performance was, well, really strong, a beat, actually. Let's talk about that core business then, the family of apps, FOA. What metrics really show that strength you mentioned?
Well, it's firing on like three cylinders. You've got reach, volume, and price. First, reach. Family daily active people users across all their apps hit 3.54 billion in September. That's up 8% year over year. Still growing globally.
And that growth is turning into dollars, obviously.
Precisely. Ad impressions were up 14% year over year across the apps. And, maybe even more encouragingly, the average price per ad went up 10%. When you get double-digit growth in both how many ads you show and how much you charge for them, that's how you get that 26% revenue jump.
Let's check the segment numbers to confirm that.
Yeah, FOA revenue was $50.772 billion, and it generated almost $25 billion in operating income, $24.967 billion. That's the engine. It pays for everything else.
And everything else being Reality Labs. AR, VR, the metaverse stuff. Revenue, there was only $470 million.
That's right. Small number in comparison. And the operating loss, still significant. Negative $4.432 billion for the quarter.
Okay, let's pause on that number. A $4.4 billion loss. Again, it feels like it's stuck around that level. Is that a sign they aren't making progress, or is it just the cost of doing business in that space?
It really seems like the latter. Management is pretty clear they're maintaining that investment level. They haven't pulled back. They see it as, a necessary long-term bet. So the consistent loss isn't necessarily failure. It's more like disciplined allocation. They're dedicating that chunk of profit to the future quarter after quarter.
That actually leads perfectly into the forward guidance. Zuckerberg mentioned the strong quarter, being excited about Meta Superintelligence Labs and AI glasses. The core business funds the dream. And the CFO's outlook, especially for 2026.
Yeah.
Wow, it shows how big that dream is getting.
Right. So first, just looking ahead to Q4 this year, they expect revenue between $56 billion and $59 billion. So continued strength on the ad side is baked in.
But wait, The Reality Labs revenue is expected to drop year over year in Q4. That feels wrong for the holiday season.
Yeah, that's a key point. It's about timing. They're comparing against the big Quest 3S launch last year, and importantly, retailers bought their holiday stock of headsets in Q3 this year, so that revenue landed earlier. It's more of a shift between quarters than a sign demand is falling off.
Got it. Okay, now the big picture strategy. The spending this year is already huge, but the signal for 2026, that really caught my eye. What are the final 2025 forecasts for expenses and CapEx?
Okay, so for the full year 2025, expenses are now expected to be $116 to $118 billion. That's like 22-24% growth year over year. And capital expenditures, CapEx, they bumped that range up too, now $70 to $72 billion, which
Yep.
is just massive. $70 billion a few years back was almost unthinkable for yearly CapEx outside maybe giant manufacturers.
But the really telling part, the deep dive insight, is what they said about next year, 2026. It sounds like an acceleration, not just keeping spending high. What were those two specific points?
This is probably the most crucial takeaway from the whole release, strategically speaking. Management explicitly said for 2026. One, the dollar growth in CapEx will be notably larger than the dollar growth was in 2025. And two, total expenses will grow at a significantly faster percentage rate in 2026 than they did in 2025.
That phrasing is serious. They're not just saying we'll spend a lot again. They're saying the increase next year will be bigger than the increase this year. What does that imply? What are they building?
It means they are all in on the infrastructure arms race for AI. It suggests they're locking down supply chains now, probably for next-gen GPUs, the really high-end chips you need for training these huge AI models. It's about building out massive AI data centers, securing power, cooling, all the physical stuff. They're grabbing capacity while they can.
So, number one driver,
Yeah.
infrastructure, the physical foundation for AI. What's driving the expense growth side?
Primarily employee costs. They need the absolute top AI talent, and that talent is expensive and getting more so. That expense forecast reflects rising salaries, plus the fact that new hires from this year will be on the books for the full year in 2026. It's a proactive bet that this massive investment now gives them a decisive edge long-term in AI.
So, we've got this picture. Incredibly profitable core business, funding a truly breathtaking investment plan. But, there are always risks. The report mentions some external pressures too. How do things like regulation fit in?
Yeah, it's the necessary reality check. In Europe, they're still navigating issues with the European Commission over the less personalized ads offering. They warned that the Commission might force more changes that could hit European revenue, and pretty soon too, possibly even this current quarter, Q4. So regulatory risk is immediate, even as they build for 2027.
And there was also a specific mention of legal risks in the U.S.
Correct. They flagged that several youth-related trials are scheduled for 2026 in the U.S., and they acknowledge these could result in a, quote, material loss. So, yeah, they're making huge long-term bets with one hand while needing to manage potentially very large near-term legal and regulatory costs with the other.
Okay, so wrapping this up, this deep dive really showed two things, didn't it? Phenomenal core business health. I mean, $25 billion in quarterly operating income, 3.5 billion users hidden slightly by that one-off tax hit, and maybe more importantly, a company signaling just an unprecedented acceleration in spending, all focused on AI and immersive tech for the long haul.
Exactly. The family of apps is the bank, and AI infrastructure is where the money's going. So connecting it all back, you've got Reality Labs consistently losing $4.4 billion a quarter, and now this explicit plan for CapEx growth to be notably larger in 2026. The real question for you, the listener, isn't if Meta is committed. They clearly are. The question is, what level of actual revenue growth, what kind of monetization from these new AI products and services will they need to show in 2026, 2027, and beyond to actually justify this scale of accelerating investment? That's the multi-trillion-dollar gamble playing out.